Hello and welcome to chapter 14 of the Accounting Insight tutorial series. In this chapter, we are going to look at the balance sheet. The balance sheet is essentially a listing of the assets less the liabilities of the business. We're going to produce the balance sheet for our sample company limited from the trial balance that we produced in chapter 12, the extended trial balance. If you're using the Excel worksheets, there is a tab there for balance sheet, and we'll start using that. If you're using paper, there is a blank sheet for you to fill out using pen or pencil. Okay, here goes. We're listing our assets and liabilities. So the first asset on our format of the balance sheet here is the van cost. So I'm going to click on that and then go to our trial balance. And the van is there. So we take the last column here, 3,000. The next thing is the van accumulated depreciation. That is the cost that you've written off to the P&L. It's gonna be negatives, and it's here 750. So what I'll do, I'll actually open a second window so that we can see the trial balance as we fill out the figures. So let's do that. Just bear with me a minute. There we go. And then I'm going to have the trial balance there. Just reduce the size so we can see it. Okay. So that is we've done the fixed asset, that's the van cost less the depreciation, so the value is there 2,250. And we're going to go to the current assets. So the difference between fixed assets and current assets are assets that you're going to use within a year or so. A fixed asset, on the other hand, is something that will last more than a year. Generally, fixed assets last at least 2 years or more. So stock is our first current asset. It is here. Let's see where my cursor is going. Trade debtors, so people who have yet to pay for computers we've sold them. That is here, 3,525. Prepayment, so where we've paid for insurance, in this case for next year as well, so that's an asset to the business, it hasn't been used. So prepayments, we said it was, where was it? Prepayments, there it is, £62.50. This balance sheet is rounding up, so you won't see pence. Most balance sheets are rounded up to the nearest pound, or some cases thousands of pounds. Cash at bank is here. So our total current assets 12,000. We then go to list the current liabilities. So those are items that the business has to pay, and they are normally payable within 1 year. Excuse me. And yeah, so the first one would be trade creditors, and we got that. Where is trade creditors? There it is. Yeah, so that's going to be negative. Actually, I'm putting them here as positives first, and then we turn into a negative down there. So we've got a formula in Excel that will make the total of these current liabilities negative, so I need to put them as positives. Presentation is just presentation. Corporation tax to be paid, we calculated that and it's down here. You see, it's a credit. VAT to be paid, work that out, there it is, VAT in balance sheet. PAYE and national insurance to be paid to the government, there it is, balance sheet 420. Net pay due to the employee at the end of the year, 700. Accruals, so where we said we will have spent some money on telephone charges, but we haven't actually received a bill or paid for them, but we know we spent it. So we create a liability for that. It's called an accrual. 47,000. So these are our current liabilities. The total 9,620. So when you deduct your current liabilities from your current assets, you get your net current assets, and it's 3,242 in this case. This business does not have long-term liabilities, like if it had a 5-year loan or a 10-year loan, you'd classify them under long-term liabilities. So what we have here is now the net assets of the business. Now, in a balance sheet, you have your assets less your liabilities, it gives you your net assets, and that is represented by share capital and equity to kind of complete the double entry system of accounting. So we then do our record of what amount of money is now owed to the owners of the business. The first bit is the ordinary share capital that the owner of the business put in. So that was £100, if you remember. And we get that from here. And this is the first year of the business, so it doesn't have reserves of profit brought forward from previous years, so that is 0. And then the retained profit for this year. So this is after doing the business for the year, the business has retained some profit in the P&L, and we saw that when we did the profit and loss account over here, and we said the retained profit was 5,393, so you put that in there. And there you go. And that is your balance sheet. So you can see your assets less your liabilities, 5,493 equals your equity, which is your share capital, £100, and your retained profits, 5,393. This has to balance. If it doesn't balance, you know you've missed a record, and that's why accountants use the double entry system of accounts. So that's the balance sheet. It's one of the final financial statements that a business produces. So I'm just going to briefly tell you the main reasons why people produce a balance sheet. So with a balance sheet like this, you can show it to your bank and say, my business is worth this amount. If you can lend me some money, I want to do some more trade the following year. And the bank manager will look at it and say, yeah, okay, you got some collateral to hold against a loan. So they'll be able to lend you some money. Or if you wanted an investor to join you and ask them to put money in, you can show them your balance sheet. So it's kind of show your net worth of the business. A number of financial ratios can be computed to show how your business is performing. And there's an appendix in the book that will go through financial ratios for you. And as you understand everything in this book, you should be able to understand what those financial ratios are telling you. Government regulations require businesses, especially limited companies now, to file a balance sheet in the interest of the public. And then later on, if you decide to sell the business, someone looking at your balance sheets over the year will have a good idea of what worth the business is. And it will help determine a price. It will be one of the factors in determining the price for the business. So that is the balance sheet. I'll quickly go through some terms that are used in financial accounts. And in the book, they're on page 19, and they're defined by the Accounting Standards Board, now replaced by the Financial Reporting Council in the UK, where they define assets as rights or other access to future economic benefits controlled by an entity as a result of past transactions. And examples in our company are the van, and the bank account balance and trade debtors. Liabilities are defined as obligations of an entity to transfer economic benefits as a result of past transactions or events. So in our example, you had trade creditors and corporation tax as examples. There are others as well. Ownership interest is the residual amount found by deducting the liabilities here from the assets. And in our case, it's the 5,493. So it's your share capital and retained profit. Gains are increases in ownership, not resulting from contributions to owners. In our example, it would have been sales. So if we looked at the profit and loss, it would be sales. Interest received. We got interest received down here. Losses are decreases in ownership interest not resulting from distribution to owners. Examples are the expenses, cost of goods sold, and then we have contributions. Contributions from owners are increases in ownership resulting from transfer from owners to their capacity as owners to the business. So where the owner of the business transferred £100 here, that is a contribution. And a distribution would be decreases in ownership interest resulting from transfers to owners. In our example, it would have been the £900 distribution to the owner here. So as you can see, we had 6,293 profit, but we distributed 900 to the owner, so we're left with that in the business. The Financial Reporting Council's definitions are wide-catching because businesses and business situations are complex. But as you study our example, you can see exactly what they're trying to talk about from the simple cases that we got in our book here. That, my friends, is the last chapter of the book where you have to do any work to understand accounting. I hope you've enjoyed it. The next chapter is going to be concluding everything and kind of briefly show you what you've been doing and maybe what you can do in the future to improve your accounting knowledge. Thank you for your time, and I'll see you soon.